Have you ever wondered what really makes a business tick? You know, it's about more than just having a fantastic product or a brilliant idea. The real secret, the real story, is told in its numbers. And today, we're going to learn how to read that story.
So many of us have that dream, right? Starting our own thing. Maybe it's a cozy little bakery, a new tech company, whatever it is. But once you've opened the doors and you're making sales, how do you actually know if you're winning? Is it just about having a line out the door, or is there something deeper going on? And that really is the big question. See, every single business has a story that's written in its finances. To figure it all out, we're going to follow a brand new entrepreneur named Maria. She's starting her very own bakery, and we're going to learn how to read its financial story right there with her.
Okay, so picture this. Maria has just opened her bakery. The smell of fresh bread is amazing, customers are starting to walk in, but underneath all that excitement, she has this really crucial question that every single founder has to face. Is my business actually financially healthy right now from day one?
And you know what? Answering that question isn't some secret code that's only for financial experts. Not at all. Understanding this language of business, well, it's an incredibly powerful tool for anyone who wants to build something, for anyone who wants to turn a dream into a real, lasting success. To really get a grip on Maria's financial health, we have to start with the two most basic building blocks of any business: what her bakery owns versus what it owes. Seriously, this simple balance is the foundation for everything else. First up, let's talk about assets. An asset is basically anything the business owns that has value. Just think of it as all the useful stuff in your toolbox that helps you get work done and, make money. For Maria, her brand new shiny oven is a perfect example of an asset. It's a real, physical thing that she owns, and it directly helps her bake those delicious cakes that bring in the cash. It creates value.
Now, on the other side of that coin, we have liabilities. And a liability, well, it's just a debt. It's an amount of money that the business owes to someone else. You can think of it as a claim that an outsider has on your business.
So, how did Maria get that fancy oven in the first place? She took out a business loan from the bank, and that loan, that's a liability. The bank fronted her the money, so now her business has an obligation to pay it all back. It's what she owes.
So, just imagine a scale. On one side, you pile up all the assets, the oven, the cash in the register, the building itself. And on the other side, you put all the liabilities, like the loans you used to buy all that stuff. Every single business is in a constant dance, managing this balance.
Okay, so now that we get assets and liabilities, we can use them to take a financial snapshot of Maria's bakery. This little snapshot tells us if her business is healthy at one specific moment in time.
This brings us right back to our main question. Now that we have these tools, can we actually figure out if Maria's dream is built on a solid foundation? Well, let's run the numbers and find out.
All right, first, we add up the value of everything the bakery owns. The oven, the building, the cash in the bank, all of it. Let's just say it all adds up to 50 lakh rupees. That's the grand total of her assets. Next up, we add up everything she owes. The bank loan, maybe some money owed to suppliers, and that comes out to 30 lakh rupees. That's the total for her liabilities. So here it is, the moment of truth. Her assets are worth more than her liabilities, and that means her business is solvent. It's a simple but powerful idea. It means the business is financially sound. If she had to, she could sell everything she owns and easily pay off all her debts. That's a good place to be.
And that difference between the two numbers, the 50 lakh in assets minus the 30 in liabilities, that has a special name. It's the net worth. Sometimes it's also called owner's equity or capital. This is the true value of the business that actually belongs to the owner, to Maria. It's what's left over after everyone else has been paid.
But hang on, a business isn't a static photograph, right? It's more like a movie. It's a dynamic game of buying and selling. Knowing you're solvent is just a snapshot. To really understand how the business is performing over time, we need to see if Maria is actually making money. We need to talk about profit and loss.
Let's say in 1 week, Maria sells 50,000 rupees worth of cakes and pastries. Awesome! Now, the cost for her ingredients, her electricity, her staff for that week was 30,000 rupees. Because her sales are more than her expenses, she's made a profit. And that profit, it gets added to your capital, making the whole business even stronger.
But what if it was a slow week? Maybe her sales were still 50,000, but the price of flour went way up and her total costs jumped to 60,000.
In this scenario, her costs are now higher than her sales. That's a loss, and that loss eats into her capital.
So now we have the snapshot, that's solvency, and we have the motion picture, that's profit and loss. Let's bring all these ideas together and see the complete financial story. And you'll see it all boils down to one simple but incredibly powerful equation.
Okay, it all starts with what you own. On one side of our equation, we put all the assets of the business, everything of value. And the value of those assets has to be balanced out. So who has a claim on all that stuff? Well, the first group of people are the ones you owe money to. Those are your liabilities. And whatever is left over after you've accounted for those debts, that belongs to the owner. That's the net worth. So assets equals liabilities plus net worth. You see, everything the business owns is claimed by either outsiders or the owner. It always, and I mean always, has to balance.
Have you ever stared at a company's financial report and just wondered? Like, can you actually trust these numbers? Well, it's not magic and it's not guesswork. It's a system. Because business, just like any good game, has a rule book that everyone agrees to follow. And today, we're going to break down those fundamental rules of accounting. And really, that's the billion-dollar question, isn't it? In this massive, complex world of global markets, how on earth do you build a system based on trust? How do you know that the numbers you're seeing on a screen aren't just, pulled out of thin air? Well, the answer is actually pretty simple, but it is incredibly powerful. It's all built on a shared understanding, a set of core principles and assumptions that basically create a level playing field for everybody involved. This, right here, this is the absolute bedrock of all financial reporting. All right, so before we can even start counting the beans, we have to agree on some foundational ideas. You can think of these as the basic laws of physics for the accounting universe. They set the stage and define the world in which all the numbers are going to live. First up, we've got the business entity concept, and this one is so crucial. What it says is that a business is its own person, legally and financially. It is completely separate from the people who own it. So we always prepare the accounts from the business's point of view, not the owner's personal one. And here's a perfect example of how that works in the real world. Let's say an owner is renting a building for 50,000 rupees. If they use half of it as their own apartment and the other half as the office, the business can only claim its share, 25,000 rupees, as a business expense. The other half, that's a personal cost for the owner. See, that clean separation is key. Next, we have the money measurement concept. The rule here is super simple. Accounting only speaks one language, and that language is money. So only transactions that can be expressed in, say, rupees or dollars or euros actually make it into the financial records. But this is where it gets really interesting because it shows a huge limitation. Think about what might be a company's most valuable assets. The genius of its team, right? Or fantastic employee morale, a truly game-changing idea. None of those things have a clear price tag, which means, amazingly, they are completely invisible on the financial statement. Oh, this is a big one, the going concern concept. We always start with the assumption that a business is going to keep on operating for the foreseeable future. Now, this isn't just wishful thinking. It actually changes how we value things in a fundamental way. We value assets based on their long-term use, not their immediate fire sale price, all because we assume the game isn't ending anytime soon. Okay, so we've set the stage with the core assumptions. Now, let's get into the nitty-gritty. How do we actually record all the transactions? These are the rules for how you keep score and keep it accurately. Now this is the golden rule. It is the absolute heart of all modern accounting. The idea that every single transaction, no matter how small, has two sides to it that are perfectly equal and opposite. It's kind of like Newton's third law for finance. For every action, there is an equal and opposite reaction. Let's see this in action. It makes it so much clearer. So Akshay starts a business with 5 lakh rupees. From the business's point of view, two things just happened at the exact same time. First, its cash, which is an asset, went up by 5 lakh. And second, its obligation to its owner, Akshay, which we call its capital, also went up by 5 lakh. The asset and the claim on that asset are perfectly balanced. And that dual aspect concept leads us directly to the single most famous equation in all of business. Assets equals capital plus liabilities. All this really means is that everything a business owns has to be claimed by someone, either by its owners through their capital or by outsiders it owes money to, its liabilities. And because of that dual aspect rule, this equation must always, always, always be in balance. Okay, next rule, the cost concept. The rule here is that when a business buys something like a machine or a building, it's recorded at the price it actually paid for it. We call this its historical cost. It's not about what we think it's worth today, it's about the verifiable fact of what it cost back then. So, why does this matter so much? Well, it all comes down to one word: objectivity. By using the original price you paid, we're grounding the financial statements in solid, verifiable fact, not just someone's subjective opinion. That furniture bought for 3 lakhs stays on the books based on that cost, giving us a stable and reliable baseline. This one is a real game changer for understanding how a company is actually doing. The accruals concept says you should recognize revenue when you've done the work and you've earned it, not just when the cash finally hits your bank account. And it's the same for expenses. You record them when you use a service, not just when you pay the bill. This gives you a much, much more accurate picture of how profitable a company was during a specific period of time. All right, for our final section, let's look at the principles that are kind of like the conscience of accounting. These are less about the mechanics and more about the philosophy, the spirit of the law that ensures we're always presenting a true and fair view of the business. This quote pretty much says it all. This is the heart of the principle of conservatism. It's basically a play-it-safe approach. Accountants are trained to be, well, prudently pessimistic. They don't want to overstate the good news, but they are absolutely required to recognize bad news as soon as it even looks like a possibility. So what does that look like in practice? Imagine your inventory costs you 25,000 rupees to buy, but you think you could sell it today for 35,000. Well, conservatism says you can't book that potential profit. You have to record the inventory at the lower of the two values, which is the cost of 25,000. It stops companies from counting their chickens before they hatch. Now, these two principles are a fantastic balancing act. On the one hand, disclosure says you have to be transparent and report all the information that's important enough to change an investor's decision. But on the other hand, materiality gives you an exception. It says, look, you don't need to clog up the financial statements with every single tiny detail that won't make a difference to anyone's decision. It's all about finding that balance. This one is just common sense, but it's so important. It's all about comparability. A company has to stick with the same accounting methods over time. And why is that? Well, because if they keep changing the rules of how they measure things, you can't meaningfully compare this year's results to last year's. Consistency makes sure we're always comparing apples to apples. So let's zoom out. Why does all of this stuff matter? Well, at the end of the day, these principles aren't just a bunch of random rules. They're the pillars that create trust. They allow us to make meaningful comparisons, they provide a universal language that the entire world of finance can speak, and they make sure that the final score is one that we can all actually rely on. And you know, these concepts aren't just some abstract theory you learn in a classroom. They are the actual DNA of modern global standards, like the International Financial Reporting Standards, or IFRS. This common framework is what allows someone in Japan to confidently invest in a company in Brazil. It creates the trust that makes global commerce even possible. All right, today we're going to pull back the curtain on something that runs the entire Indian business world, its financial rulebook. Now, I know accounting standards might sound a little dry, but trust me, this is the stuff that makes our whole economy tick. It's the reason we can actually believe the numbers we see. So let's dive right in. So let's start with a thought experiment. Just what if every single company made up its own rules for counting money? You've got one business over here that counts a sale the minute the contract is signed. But then another one, right next door, says, nope, we don't count it until the cash is physically in our bank account. I mean, how on earth would you ever know who's actually doing better? Honestly, it would be total chaos. You'd be looking at a financial report and it would be a complete guessing game. For investors, for business partners, for anyone just trying to understand. There'd be no real way to tell if a company is strong or if it's just, good at creative math. Okay, just look at this. On paper, Company A looks like a rock star, right? Double the sales of Company B. But hold on, are they really more profitable? Or are they just counting their chickens before they hatch? See, they're not playing the same game. They're using completely different rule books. And that makes it impossible, literally impossible, to compare them apples to apples. And this scenario, well, it plunges us right into a world without rules. It's a place full of financial smoke and mirrors, what people sometimes call creative accounting. And here's the bottom line. It's actually super simple. When there are no shared rules, there's no trust. Period. Investors get spooked, the market goes haywire, the whole system starts to fray at the edges. What we absolutely need is one single yardstick that everyone is measured by. And that right there is exactly why India created its own financial rulebook. It was time to bring some order to that chaos, to create a common language for business. Let's see how they did it. So this official rulebook is called, well, Accounting Standards, or AS for short. The best way to think about it is like this. It's the official grammar of business. It sets the rules so that when a company tells its financial story, everyone can understand it, compare it, and, this is the big one, actually trust it. Now, this whole system didn't just appear out of thin air. The real work started back in 1977. That's when the Institute of Chartered Accountants of India set up a special group, the Accounting Standards Board, with one job, write the rulebook. And by 1991, these rules weren't just suggestions anymore. They became law for companies, and that really changed the game for Indian business. Okay, so we have the rules, but what do they actually do? Let's get into the specifics and look at a couple of key standards to see how they work in the real world. All right, remember that whole mess with Company A and Company B? Well, a rule called AS9 is the referee. It lays down the law on exactly when a company is allowed to book a sale as revenue. No more jumping the gun. This rule is what prevents companies from making their numbers look better than they really are by counting money that isn't really theirs yet. Next up is a big one, being honest about your stuff. I mean, a factory machine, a delivery truck, they don't last forever, do they? They get old, they wear out. AS16 is the rule that forces companies to face that reality. It's called depreciation. It just means they have to reduce the value of their assets over time so the number on the balance sheet actually matches reality. And then there's the stuff a company plans to sell, its inventory. AS2 handles this. It basically says you can't pretend the stuff in your warehouse is worth more than it really is. So if you have 1,000 old phones that nobody wants anymore, you can't value them at their original price. You have to be realistic. This keeps the books honest. But you know, the world doesn't stand still. And business is definitely not just a local game anymore. As India became a bigger player on the global stage, its rulebook needed an upgrade. It had to learn to speak the international language of finance. Think about it. With money and companies flowing across borders, you needed financial statements from an Indian company to make perfect sense to an investor in, say, London or Tokyo. The old local rules just weren't enough. India had to get in sync with the rest of the world. And that's where something called IND-IS comes in. Now, what's really cool is that India didn't just copy and paste the international rules. No way. They took the global standards, which are called IFRS, and then they tweaked them. They customized them to fit India's own laws and the way business is done here. So it's like the best of both worlds. So where are we today? Well, all the big players, the large listed companies in India, they have to use these new IND-IS rules. Smaller companies can still use the old AS for now, but the long-term plan is pretty clear. Get everyone speaking the same global-friendly financial language. It's all about creating one single unified system. Okay, so we've gone through a lot of rules and acronyms, but let's bring it all home. Why does any of this stuff actually matter? To you, to the economy, what's the real takeaway? It matters because trust is everything in finance. And these rules, they're the bedrock of that trust. They give investors confidence. They let us compare companies fairly. They make it easier for Indian businesses to compete on the world stage. And all of that together, it helps build a stronger, more stable economy for every single one of us.